welcome everyone to Voyage 2021, and many thanks to Aditya Birla Sun Life for inviting me along to speak to you today. What I'm going to try and do is set the scene for what's going to happen over the next year and then the next few years, not just for India, but for the global economy. Because this is obviously a crossroads for everyone, given the pandemic that we've had over the year 2020 and ongoing this year. But it's not the only problem that the world faces. What I'm going to do is share with you some thoughts about the advanced economies and then the emerging markets. So let me bring up if I can here, just a screenshot of my presentation called The View Across and Beyond the Horizon. Where are we now in the, if you like, the world economy's growth pattern? We're very much at the tail end of COVID-19, which has dominated the headlines through 2020. But over the course of the next year or so, as vaccines are rolled out and as more people catch the virus and become immune to it, it's going to become less and less of a threat to economic activity. So our view is that the headlines of the last year are probably not going to be repeated this year. There's still going to be lockdown phases and disruption in economic activity. But with a bit of luck, we'll be back up and running much more like normal. However, it's not just the virus that we should be worried about in terms of the outlook for the global economy. Because Donald Trump, while he was president, made a big deal of calling the COVID-19 virus China flu, and that the China flu was the biggest problem facing the world today. Well, I don't think that's true. I think the fact is that we have a much bigger virus to worry about, a much bigger problem going forward in terms of economic policy making. The problem in economic policy making has been raging for the last 20 years nearly. It started in response to the 9/11 events of 2001, when Ben Bernanke, who was then the deputy chairman of the Federal Reserve, and Alan Greenspan, who was the chairman, decided that the response to the events of the terrorist attack in the World Trade Center was basically to lower interest rates to 1%. Fed fund rate was cut to 1%, the lowest that it had ever been at. And in the few years that followed, there was a huge expansion in risk-taking activity in terms of people investing in capital, and specifically investing in real estate. That then ended up as the global financial crisis in 2008, 2009. But the flu didn't go away, even though interest rates had risen from 2003 to 2005-06. Thereafter, they were cut even further. Ultra easy monetary policy, zero interest rates, quantitative easing, all sorts of nuances and new ideas in how central banks should support economic activity have become the policy-making norm for the global economy, and in particular for the advanced economies. We call this American flu because that's where it started. Ben Bernanke was the architect of these policies He's still around peddling them like any snake oil salesman peddles his wares. Because the damage that these policies have done behind the scenes, rather than the obvious positives, supposedly, of much higher equity prices and much higher asset prices, behind the scenes, the damage has been in terms of the increase in what we can call zombie companies, especially in the advanced economies. Now, what are zombie companies? We've all heard in recent years about zombie films, The Walking Dead, and various TV series. But in actual fact, the term zombie companies is quite an old one. It dates back to the 1990s, when people talked about the problems in Japan and the fact that Japanese banks were in trouble, and those Japanese banks kept supporting some of the weak companies in the Japanese economy. The term zombie became associated with Japan's economic problems. The Walking Dead were the Japanese banks and a lot of Japanese construction and real estate companies. The new zombies are associated with ultra-easy monetary policies, especially exceptionally low interest rates. Those zombies are mostly companies that don't make any money. And I'll show you in a second what this is like. But what they do in the global economy and in the economies where they exist is to stifle economic growth, to suppress it, to depress productivity, and to dissuade new, vibrant companies from even beginning to exist. They steal the resources, effectively, that should be going to new startups and to newly created companies. They steal the loans, they steal the labour, and they steal the capital, and they hoard them. And the result is much weaker economic growth. Now, how do we know, and what are zombie companies? How do we know they exist? Quite a lot of work has been done on this over the course of the last number of years, especially by agencies like the Bank for International Settlements and the OECD. It's important to remember that it's people like that that are developing the theme of zombie companies, because the BIS and the OECD are much more involved with rich countries than they are with poor countries and emerging markets. They really are the central bank, the BIS, the central bank to the central bankers. And in the OECD, it's the Organisation of Economic Cooperation and Development for the rich countries. But that's where the focus has been on the rise of zombies. So from this chart that I'm showing you at the moment, you can see, especially on the left-hand side, that the normal definition of zombie companies and how many there are. That normal definition is basically companies which cannot pay their interest on debt from their earnings. In other words, their profits aren't big enough to pay the interest on how much they've borrowed. Not in 1 year, not in 2 years, but 3 years running. And not for new companies, but for companies that have been at least in existence for 10 years. So these are mature companies that are listed on stock markets and who can't even pay the interest on their debt from the amount of money they make in profit. Now, the interesting thing from that chart in the left-hand side is that if we go back to 1990, there were no zombie companies. The red line there shows you how many zombie companies there were on stock markets. And it's basically around about zero. Then it starts to grow in the 1990s, mostly Japan in this instance, and falls back. But then it keeps ratcheting up and it keeps ratcheting up. And when we get to 2015, 2016, the number of zombie firms is in the region of 12%. Now, this isn't just 12% of Japan. This is 12% of 14 advanced economies. 12% of the companies listed on stock markets can't pay, or at that point, couldn't pay the interest on their debt from corporate earnings. By 2018, that had risen to 15%. And we don't know yet what the effects of the pandemic will be in terms of producing more and new zombie companies. But given how much interest rates have been kept low, we should expect more of these zombie companies to come into existence, because the thing that feeds them is very, very low interest rates. When interest rates are exceptionally low and central banks are printing lots of money, it makes it easy for the banking system to extend loans to companies that are otherwise not very healthy. And why would a bank do that? Well, the specific reason for banks extending loans to weak companies is to stop them becoming bad assets on the bank's books. Now, in India, we know all about this over the course of the last 10 years. There was a period where evergreening and ignoring bad debts was a real problem for the public sector banking system in India. I can come back to that later. But this is also true in the West, that banks are increasingly lending to these zombie companies. The result of that is that advanced market economies are becoming thoroughly compromised by the existing levels of zombie companies and the levels of debt that these companies have. Our conclusion in a report that we produced just a few months ago is that the Japanification of the US and Europe is well underway. Now, we don't mean by Japanification that the US and Europe will actually look anything like Japan, that will produce food like the Japanese or be as homogeneous as Japan is and lock the borders to foreigners. All we're saying here really is that their economic growth rates are going to head towards the Japanese levels that have been experienced over the last 30 years, because that's what zero interest rates produce, lower and lower economic growth. What does that mean for emerging markets in countries like India, but maybe more so countries in the East Asian norm of export-led countries? Well, it means that they're unlikely this time to have the kind of export springboard that they've had in past crises. It's been the case certainly during the Asian crisis, that the thing that produced economic growth quickly after 1997, 1998 was fast-growing advanced economies. The United States in the late 1990s was growing at 4% in real terms a year. Europe was growing at 3.5%. These were exceptionally high growth rates, and what they produced was a major extension of the export markets for now very competitive Asian countries to sell into. So that export springboard became the recovery process from crisis. That's no longer available. It's not available to India, it's not available to China, it's not available to the emerging markets generally this time round, and it won't be for the next few years. And I don't just mean the next couple of years, but much more likely the next decade. So that means that emerging markets have got to really produce the goods themselves. For the first time ever, the onus is going to shift towards emerging markets, and especially the big emerging markets, to produce domestically led growth. That means big thinking. by governments. It means that structural reforms in economies that are relatively weak in that respect are going to have to be undertaken. Liberalisation is going to have to happen, and policy making generally is going to have to improve. Now, there's some good signs in that respect, and again, I'll come back onto them in a few minutes. The two countries, when we produced our year-end strategy report, that we liked a lot in terms of what was happening as regards this big thinking, were India and Indonesia. Although there's question marks about the game-changing reforms that have already been announced in these countries, and obviously in India, you're well aware of the problems in trying to get the agricultural reform bill through and the law being enacted, causing the government all sorts of problems in that respect. But the fact is that the government has recognised that agricultural reforms are required, that labour law reforms are required, and these are very much game changers for the Indian economy. Indonesia has produced something very similar in terms of its foreign direct investment attempts and indeed its own labour law reforms. So these are good pieces of good news. China hasn't done so much in the way of big reforms, and I'll come back to that as well in a second, but it maybe doesn't need to. The other country that's talking a lot just now about significant changes to its 1987 constitution, and nothing has ever been changed in it since 1987, is the Philippines, where again there's talk about economic reforms which are going to allow foreign direct investment to take a much more active role in the Philippines economy. So things are afoot, times are changing, and that's good. And the great news for these countries, including India and Indonesia, is that interest rates are not a barrier to economic growth. They're not a barrier to getting rid of zombie companies. Effectively, what interest rates in much of Asia do is allow creative destruction to take place. When interest rates are high, bad companies go bust. When interest rates are high, good companies that have a good business plan and a high return prospect can come into business without any problem. They borrow and they can repay their loans because their economic growth, their profits are high. And that's a positive for every country. The problem for countries is very low interest rates. When I look at this chart about official interest rates in Asia from the beginning of last year when the pandemic started to the latest that we have just now, I'm encouraged by India, by Indonesia, by Malaysia, the Philippines, Vietnam, China to a certain extent. All of these countries have interest rates that are relatively positive and relatively high. Not high relative to GDP growth, but relative to the rest of the world. When I look at countries like Japan, I just shake my head and say they're stuck with close to zero growth. Because when interest rates are as low as that, what they're telling people about the future and what they're telling companies about the future is that there's no growth coming. When interest rates are close to zero, the signal to businesses is that the economy is stagnating. And that's never a good signal. So countries like Japan, and I would say I would be quite worried about Thailand as well, have interest rates that are not commensurate with fast growth. That's not a positive for the economy. Now, what about China? I want to take you on now to talk about China before we go into emerging markets more generally, and then India. China, after the global financial crisis in 2008-2009, effectively saved the world. China was the country in the world that did the job, the heavy lifting, that the advanced economies had done for Asian countries in the late 1990s. Why do I say that? Well, when the global financial crisis struck in 2009, China imported around about $1 trillion worth of goods and services a year. By 2012, 3 years later, China's import bill was $1.8 trillion a year. Just to put that in context for you, that was the same size, that import bill, as the Indian economy in the same year. China's import bill was the same size as Indian GDP in 2012. And it had gone from $1 trillion to $1.8 trillion, nearly doubled in the space of 3 years. So China really did save the world in the wake of the global financial crisis. This time, it certainly improved its performance relative to the start of the year when the pandemic broke and everything was locked down in China, and it became one of 3 countries in Asia to turn in a positive GDP performance for 2020 and a positive export performance. Pretty amazing for the country where the virus started. But that's not what makes China an outlier. It's not an outlier because, in actual fact, Taiwan and Vietnam, the 2 other countries that have had positive exports and positive GDP, have both grown faster than China. But where it is an outlier is in that China has been restoring policy to much more like normal, to normality, since the middle of the year. Interest rates bottomed in May and have gone up since then. Policy has continued to be controlling of what's going on in the property market, making sure that real estate doesn't get out of control. And they continue to try and squeeze the shadow banking system that became a significant problem for China around about 2012, 2013, when wealth management products and non-bank financial companies really began to take off and to a certain extent rip off Chinese investors. So normality and a normalization of policy has been the thing that has set China aside from everybody else. Nobody else has managed to do that since this crisis began. The result, in our view, is much better policy signalling to businesses in the Chinese economy, and especially new businesses that are looking to invest. Interest rates are such that they're not particularly high, but they're not low. They suggest to the potential business person, the entrepreneur, that economic growth is going to be quite positive in the years going forward. But they need to be careful. They can't just borrow and expect to easily meet their repayments because interest rates are relatively high. But these positive growth dynamics and the positive policy positioning are very good news for the cycle in China. It means that there's sustainable growth coming, there's sensible growth coming, and the likelihood is, given that the returns will be high, probably an upside for the currency and indeed for assets in China. So that's a real positive for the global economy if the second biggest economy in the world is producing decent growth. And there's just a couple of examples for you of what happened in China over the course of the last year. In particular, as I mentioned to you, if we just look at that period there, where we have interest rates falling to their lows in May 2020 and then heading back up. That's certainly been a big difference between China and the rest of the world when it comes to the way that policy has been positioned. And that second chart shows you the pressure still being put on the shadow banking system when elements in the system like entrusted loans, trust loans and undiscounted bankers' acceptances are actually declining, and declining at an increasing rate since the third quarter of last year. So these are positives for the Chinese economy. And we've seen it in terms of its rebound in economic activity terms. I'm just showing you here a couple of indicators that we follow. We actually follow 8 indicators. I'm not going to show you them all for China, but the Purchasing Managers Index is back up and running the way you would have expected after a very, very sharp downturn in it. By mid-year, it was upwards of 53, 54. In China, the PMI doesn't usually get very high, as you can see from previous years. But the economy was recovering. And that was true of the picture from electricity production, one of the more reliable indicators for the Chinese economy. So we're certainly in a period where China is not just normalising in policy terms, but normalising in activity terms, told by the indicators on the ground. That's very good news, as I say, for the global economy. And when we then look at what's happened for the rest of the Asian region, the main thing to note here is that trade balances have all been improving. And as those trade balances have been improving, then currencies have been rising, with one or two exceptions. As you can see on the second chart there, 2 countries did actually have depreciating currencies last year, Indonesia and India. Both of them, though, have had improvements in their trade balance during 2020, and in our view, are actually 2 of the best bets for currency appreciation this year. We would be looking at the Indian rupee certainly heading towards 70, if not below the 70 mark during the course of 2021, and the Indonesian rupiah also heading 3, 4, 5% higher during this year. But the great news is that basically for the whole of Asia, we're looking at external surpluses and conditions that support stronger currencies. And that, from an investor's perspective, especially a foreign investor coming into the region, is particularly attractive, given that economic growth will also be recovering. Only one country in Asia, and that's Korea, had a worsening trade balance last year, partly to do with the fact that their exports to China were so weak in the early part of the year. So let me just show you what we've been doing in terms of our strategy in global terms from Aletheia before I go on to India. And what you can see here is that we've been suggesting to our clients, not all of these, by the way, are new global strategy calls. Some of them are some years old, but they should be long emerging Asia, short developed countries. Now, we've had this in place for too long. We introduced it a few years ago, and it hasn't worked that well until the last year. At the moment, that actual trade, long emerging Asia, short developed countries, is still down 0.6% from its inception. But that's the one that I'm most confident in going forward. So as I've been saying to you all along, we like emerging markets and we don't like developed countries. We also don't really like the US dollar that much. We're short the nominal effective exchange rate. That's a trade that's gone up 4.6% since we put it in place last year. Our long on Asian frontier markets, which include places like Vietnam, Bangladesh, is up 6.5% since we started it. But it's the last 3 which have been the big winners for us in the last year. The recovery in dry bulk shipping has obviously taken off with the recovery in the global economy and demand for commodities. But that trade is now up 21.5%, and we expect it to go significantly higher over the course of the next few months. Blockchain, which is associated with another report that we wrote last year on cryptocurrencies, but is a much more, I would say, less volatile way of playing Bitcoin and cryptocurrencies than actually buying the currencies themselves. Blockchain, you can buy an ETF on it, and that is up since we started this trade 51% in the course of the last 3 months. And we're also long Vietnam as one of the big winners over the course of the next few years, which that trade is up 15.5%. So that's just to let you see what our emerging market and global strategy is at the moment. Let me finish off with a few words about India, and by all means I'm happy to answer questions about India. As I mentioned to you earlier, big thinking is required by emerging market governments in order to substitute domestic demand for export-led demand. Structural reform and liberalisation over the course of the next few years is going to be essential. Now, the agricultural reforms and the labour law reforms that were announced in September last year were big steps in signalling that the Indian government gets that message. And that's very, very positive. But it's also positive that when I look at this year's budget, I'm very heartened by the increase in transparency and the increase in realism that the government has shown as regards the budget. Now, I know that people have been worried about the 9.5% budget deficit that's going to be for fiscal year 2021, and then it only goes down to 6.8% in fiscal year 2022. But bear in mind, the pandemic has been an absolutely unique set of circumstances for governments. Governments, for the first time ever, closed down businesses. Now, people have likened the COVID-19 to the war and the fact that action had to be taken. The problem with that is that during wartime, activity never stops. Activity actually increases and it heightens. During the pandemic, governments locked down economies. They stopped supply. And it was therefore incumbent on governments to step up to the plate and protect capital structures, protect businesses, protect the industrial structure, protect jobs. And I think India has done a pretty reasonable job in that respect over the course of the last year, both the RBI and the government. The 9.5% budget deficit for 2021 doesn't bother me at all. It wouldn't make me not invest in India. I'd be quite happy if other governments were actually as realistic about these numbers as India has been. And at the same time, what the government has also done, or the finance minister has done, is use that opportunity of a problem time to make it much clearer what is behind some of the budget figures. The inclusion of food subsidies on budget, I think, is a major step forward for India. That alone was around about 2 percentage points of the 9.5% deficit. It's going to come down this year, but the fact that they're now on budget is a very big positive for India. In fiscal year 2022, I think the revenue and the deficit projections are realistic. Around about 14% nominal GDP growth, to me, looks quite possible given the base year effect. And that's all the government's forecasting in terms of its tax revenue increases. So that, again, I think is a realistic prospect for India. The fact that capital expenditure is at the heart of the government spending for fiscal year 2022 also realises that it's got to be domestic-led growth that's going to drive economic activity going forward. All very well to open up to foreign investors and to change labour laws that might attract some more export industries, but more's got to be done domestically. And I think this budget was certainly cognisant of that. Commitment to increase foreign ownership and insurance, again a positive, but much more positive was the call to sort out the banks, put aside 200 billion rupees for recapitalisation of the public sector banks and announce some consolidation there. That's been a running sore in India for the last few years, and now it's being addressed. So, in conclusion, we think 8 to 10% growth in India is quite possible and quite easy, as long as these kind of management rules are followed and that the government follows through in terms of its liberalisation and structural reforms. Is that a 2-year, 3-year, 8 to 10%? Absolutely not. Given the demographics of India, that's at least a decade. So, in terms of the far horizon, not just the year-long horizon, the prospects for India and for emerging markets are better now than they have been for the last 20 years. Let me leave it at that and hand back for any questions.
Many thank you for that wonderful presentation. First, I'm just going to take a moment to welcome everybody on behalf of the Builder team and ET Now team. It is an absolute delight and pleasure to be associated with this event, and this year voyage is indeed different. We are at a cusp of an economic recovery, markets at an all-time high, the animal spirits post the budget has been unleashed. I used to always consider myself as a compulsive bull, but when I meet somebody like Jim Walker, our optimism is just getting endorsed. We are talking about decades, cycles, and trends, so I'm going to be just talking about trends and decades. Jim, I'm going to pick it up from where you left last time, which is your view on India. Now, Jim, you're a big believer in cycles. 1970s and early 80s, it belonged to Japan, followed by US, then China, and last 10 years were in a sense dominated by a huge expansion in the US economy. US economy expanded like never before. Do you think this decade belongs to India?
I think it can belong to India. I think it can belong to emerging markets in particular, as long as the governments understand what needs to be done. That this is not a time for waiting for the West. It's a time for taking proactive policies themselves, putting them to the fore, making sure that they're addressing the issues. I mean, as I said to you just a second ago, one of the key elements I've been worried about in India for the last number of years now has been the inability to address the public sector bank problem and to effectively put in place the bankruptcy and insolvency code in the way that the RBI designed it. Now, I think that the government has recognised that it probably made a mistake by not tackling that problem when it first had the chance to do it, and is now tackling it, and that's a real positive for me for India. And again, the signals in terms of labour law and agricultural reform, even if the agricultural reforms are stalled and they have to be either simplified or changed to some extent, the signal is there. The signal that the government is getting its act together, recognising its problems and addressing its problems is, I think, very clear. And given India's demographics and its potential, if a government really gets its act together in that way, then 8 to 10% growth for a decade is easy.
What could spoil the bullish and the optimistic outlook, Jim? Could it be a threat that inflation comes back? Because when inflation comes back, it's difficult to control. Could it be a complete change in the Fed policy, looking at the way how things are moving? What could challenge this bullish outlook?
Yeah, the bullish outlook for India has nothing to do with the Fed. And to be quite honest, for me, the Fed has got everything to do with the bearish outlook that I have for the advanced economies. The good news is that the RBI hasn't followed the Fed, and to the extent that some other countries have, and most emerging markets haven't followed it. Could inflation come back to derail the outlook? It's always a danger in various countries, but let's be clear about what inflation is. Inflation is not temporarily higher food prices or higher oil prices. Inflation is about accommodating shifts in prices, whether it's commodities or food. If the central bank is printing so much money that inflation can get a grip, not just in specific sectors of the economy, but generally, then we could have a problem, because then interest rates need to go up significantly. But the good news is that I don't see that happening, and I don't think India is at that game at the moment, and I don't think many of the emerging markets are. I think they're all being relatively careful. India is worried so much about its budget deficit. It's considering, and not considering, it's forecasting that it will come down 3 percentage points in the first year after a crisis. That's not, to me, the kind of economic policy environment that's suggesting that they've gone soft on inflation. Far from it. So I don't think that's a problem for India. I don't think it's a problem for many emerging markets just now. I think the bigger problem is just the dangers to the global economy that zero interest rates in the West might produce just in terms of economic growth going forward.
In your presentation, you mentioned that US is moving towards Japanification, which means low rates and no growth. Now, US is the biggest economy, more than $20 trillion. If the biggest engine in the world starts to slow down, I'm sure it will have implications which for the moment are difficult to predict. Is that the risk which indirectly or directly could hurt emerging markets?
Yeah, it's a risk, but the beauty now is that when you start adding up the emerging markets in terms of their GDP, China, if I remember rightly, is around about 16% of global GDP. You add on Latin America, India, the other emerging markets around Asia, and you're starting to get towards 30% of the global economy very, very quickly. Now, 30% of the global economy growing at 5, 6, 7% a year is a big, big boost to economic activity for emerging markets. We don't need the United States to be completely going gangbusters anymore. If the emerging markets themselves can really step up to the plate, it's got to be self-help over the next 10 to 20 years. We can't rely on the advanced countries, the rich countries, to deliver the goods. I just don't think they're capable of doing it. Certainly not Japan, and increasingly not Europe and the United States. It's got to be the emerging markets themselves. And that's why, big thinking, structural reforms, liberalisation have got to be the order of the day.
Now, last time when we saw such a strong cycle, Jim, for emerging markets was, let's say, between 2003 and 2008, where everything moved up in a synchronized manner. Big capex expansion, big credit expansion. In India, the animal spirits, in a sense, was clearly there. How different do you think we are from the previous emerging market cycle, which we saw, let's say, 15 years ago?
Yeah, 2003 to 2008 was very different, because what was happening at that time was that given those very low interest rates that had followed the World Trade Center attacks, the terrorist attacks in the United States, there was a buoyancy in asset markets and in especially European and American real estate markets. So that buoyed the investment cycle, it buoyed the banking system, it buoyed economic activity generally, and that just fed around the world. And other countries joined in. bear in mind that a lot of Asia was really just recovering strongly at that point after the Asian crisis. I just don't think we can expect that same real economic activity response to zero interest rates after 20 years. I think the fact is that increasingly, as I've tried to point out, the evidence is that zero interest rates cause much less economic growth rather than much more economic growth. So we need to look to the countries that don't have zero interest rates. Now that, as I say, at least includes China, India, and large chunks of the emerging market universe. That's where the growth buoyancy is going to come from going forward. So it's up to ourselves this time round, not the Americans and the Europeans, I'm afraid.
Jim, let's look at the composition of Indian economy. We are a service-dominated economy. As per the percentage of GDP, service sector has the highest contribution. That's one part. Then you got agriculture, manufacturing, and consumption. If you're talking about 8 to 10% growth, which end of the Indian economy do you think is going to be leading this economic growth?
Yeah, now bear in mind that for nearly all countries, the service sector is the dominant sector of the economy in GDP terms. But GDP is not a very good measure of what is happening in economies. Remember, it's really all about final demand. And this is where I think we get a lot of confusion about the state of economies, because GDP is mostly focused on consumption, so that's mostly on services and some manufacturing. But the backward linkages of the economy into investment are really what's critical for economic growth. Those never get counted in GDP. They get counted in other numbers, but they're never counted in GDP. And that's where, even in India, if you look at the GDP numbers, you will be misled in terms of the strength of services relative to everything else, because the feed through into the rest of the final demand sectors of the economy comes from investment. And it's creating the conditions for investment to thrive, which basically means creating the conditions for profits to thrive. That is good news for every economy. Now, that means running sensible policies, not too low interest rates, not too high, but the government coming in to try and support business growth, to support expansion, and to support the backward linkages in the economy. And those backward linkages are all about capital equipment and manufacturing and production. And that's where the growth is going to come from in India in this cycle. I would be very long the early cycle stocks of India at this point.
Jim, they say in markets they tend to price in all the good news well in advance. Markets climb the wall of worry and they come down on ray of hope. While a year ago there was only despair and there was only panic, we've seen perhaps all emotional behavior of the market in last 1 year, from fear to despair, from participation to FOMO, and now touch of euphoria. What in your mind currently is the most dominant behavior in financial markets, both locally and globally? When you see episodes like GameStop and what Robinhood traders are doing, it makes you wonder that are we going through a patch of euphoria?
Yeah, well, I think in countries where, again, I go back to zero interest rates, where there's zero interest rates, there's euphoria. Until those zero interest rates aren't enhanced by even more central bank or government policies. And of course, part of the euphoria in the United States over the course of the last few weeks has been the prospect of, a big stimulus package from the government. So the great danger that I think that we face at the moment in markets is that it's all about stimulation. It's all about central banks and governments. And it's not about real quality corporate earnings. Now, I would say that that's certainly true of the developed countries and the stocks that you've just mentioned, and the speculative ones that are in businesses that probably have nowhere to go. That's completely the case because they don't have corporate earnings. The good news, again, is that in emerging markets, I think increasingly people around the world are looking at emerging markets and saying, there's the earnings. That's what we're looking for. And there's a very strong possibility of a rebound in those earnings. And even though we're using interest rates to discount the future flow of earnings, those interest rates are sensible and that future flow of earnings is real. So these are very, I would say, positive investment signals for the emerging markets. I think there's much less in the way of positive investment signals for the developed countries.
Jim, since we're talking about decades, and before I move on to a lot of questions which we are getting from the attendees, and I would encourage more questions from the attendees, and a whole range of questions are coming, I'm going to put you in a spot. And my question to you, Jim, is, if Jim Walker has to identify 2 assets or 2 investments which he's happy to keep for next 5 to 10 years, which are those 2 investments? And if Jim Walker has to go short on 2 trades, which will be those 2 trades?
So the 2 longs, I think, are reasonably easy. I've mentioned one already, blockchain. The technology behind Bitcoin. But it's not just Bitcoin. That technology of distributed ledgers and the ability to keep information private, I think is going to be a huge future growth industry. So I would be long blockchain for sure. Where else would I be long? I think I've got to go with our recommendation in our global strategy report, and that's to say that the standout country in the Asian region just now, which has got a long way to go, is Vietnam. I like India, but I like Vietnam even more. So these are my 2 longs. What would I be short? The main thing that I would be short is developed country, and specifically American stock market indices. That's not been a good short this year, but I think going forward that will increasingly be a good short. I don't put very much money into the US stock market myself. I've preferred other areas, especially emerging markets, and I'm quite comfortable with that. And what else would I be short? It still has to be, even though it's not in our global strategy list, it would have to be short sterling, given the huge fallout from removing itself from the EU, the Brexit disaster that is unfolding just now, plus my own expectation that the United Kingdom will be broken up over the course of the next 5 years, and my own country, Scotland, will become independent. That will leave sterling, I think, floundering.
Okay. I'm going to take a question from Ramji. He's an attendee. Thank you, Ramji, for that question. Now, first, Jim, Ramji is thanking you for a brilliant session. And he's perhaps asking the obvious, which is that US dollar for the longest time has enjoyed a reserve currency status. The fact that US is printing money, and they've printed more money in the pandemic crisis more than last 4 crises put together, according to Stanley Druckenmiller. What are the chances that US currency would lose its relevance in today's time when the macros are getting weak, they're borrowing from future, and a company like Tesla has started accepting Bitcoins?
Yes. Quite interesting, isn't it, that Tesla is taking Bitcoin? That's a good question, Ramji, and I completely understand where you're coming from. If we went back to 1971, when Richard Nixon closed the gold standard window. At that time, gold was $40 an ounce. Today, as we know, it's $1,840 an ounce. And everybody talks about that and looks at it and says, oh, gold has gone up X 1,000% against the US dollar. Well, the other way to think about it is that the US dollar has lost 98% of its value against gold over the last 50 years. If you had a pound of gold, even a few ounces of gold in 1971, you'd be a very rich person today. But that's the problem, that countries like the US and everybody else keep printing much more money. The US dollar has lost 98% of its value against gold. Sterling has lost 99%. So in other words, sterling's down 50% relative to the US dollar, because the difference between losing 98 and 99% is a 50% decline. So unfortunately, fiat currency countries, and that includes lots of emerging markets as well, have printed far, far too much money. They continue to debase themselves. Now, fortunately, we can take some avoiding action in assets, because those asset prices go up. But it's just a question of who's trying to reach the bottom fastest. And they're all in it together, I'm afraid. So Bitcoin, I don't have any myself. I like the blockchain side. Gold I do have, but I would not dissuade anybody from owning Bitcoin and certainly just accumulating it through time. But I do the same with gold, and I'm the same with blockchain. Oh, I can't.
Nikun sir, you're on mute.
Yes.
When it comes to talking about wealth, I should never be on mute, so I'm going to ask my question loudly again. Jim Walker, the richest men on this planet all have a technology background. I got Tesla as a technology company, then Amazon. Bill Gates has dominated the #1 position for a long period of time. In this decade, if you have to identify the richest men on the planet, which sector, which country, and which segment do you think they will come from?
Yes, good question. Hard one to answer. There's no doubt that there's a lot still to go with technology. Electric vehicles are going to continue to be at the top of people's wish list and think list. Last year, when the pandemic broke out, we put forward a rather unpopular at the time call, which was that investors should accumulate automobile companies. My view there was that the private car is a much safer mode of transport in terms of the virus than buses, trains or trams. And people like Ford Motors and Volkswagen have way outperformed indices. But I'm not sure that that's a decade view. I've got to say that technology in the emerging markets, places like China and India, and I don't know enough about technology to know which companies to invest in there, but that's the real explosion of the future. Not just because technology is the thing, but technology has a different aspect to it that I think people forget. And that's that it effectively replaces physical infrastructure in terms of sending information flows around an economy. And information flows are everything to getting markets moving and economic activity moving. So the more technology is adopted in emerging markets, the bigger the bang for the buck, because it replaces physical infrastructure that would otherwise have been required to get information flows to the market. So where I would put my money is in technology stocks in emerging markets, especially the big ones, the big two, China and India.
Okay. It's a great point from Mr. Walker that he would put his money in technology stocks, both big in India and China. Final question, sir. It's a combination of what is there on my chat window, and I'm going to add just one prelude to it. Bill Gates famously said that we will always overestimate the rate of change in the short term and underestimate the rate of change in the long term. Where do you think we are overestimating the rate of change, and where do you think we are underestimating the rate of change?
Yes, good question. I suspect we're underestimating the rate of change in energy production. It's going to become increasingly obvious to everybody that energy is going to have to be produced in a much, much cleaner way going forward. I suspect that's where we're going to be surprised at how dramatic the uptake in renewable energy and clean energy is going to explode upon not just the developed countries, but the emerging markets as well. Where have we probably overshot? I hesitate to say Zoom and Teams and things like that, but maybe the virtual conferencing has already overshot somewhat.
Well, we are meeting on a digital forum right now. So for the moment, we are saying that we're enjoying what could be called as compulsion, because I frankly don't know if the digital platform was not there, we would have convinced you to join us late at night post-dinner. Ladies and gentlemen, before I give it to Sumit, Jim Walker is joining us from Hong Kong. He's finished his dinner, and the fact that digital technology like Team is making it happen today.
That's
Sumit, true. Thank you. Thank you, Jim. I always appreciate your views. Thank you on behalf from the Birla team and ET Now team connecting with you. Just when I may share it from my experience of interacting with Jim, when you are in doubt about India, don't worry, call Jim Walker. He'll convince you that the India story is live and kicking. Sumit, over to you.
Thanks, Nikunj.